Everyone tells you don't trade patterns, only long term investing works. But there is one pattern traders use that actually explains every 2x, 5x, 10x wealth creation in mutual funds. Most investors never make money from this pattern, not because this pattern fails, but because investors fail during this pattern. You have seen this during the Nifty 2008 crash and recovery, 2020 crash and recovery. You have seen the markets fall, consolidate, and rise slowly, and then suddenly it explodes to a new high. That entire cycle is called the cup and the handle. Every time the market forms a cup, the next multi year cycle is created. But here is the tragedy: most investors stop SIPs inside the cup, they redeem during the handle, and they invest after the breakout during the most expensive phase. Cup and handle is not a trading pattern, it is a psychology of long term wealth that most investors have misunderstood. Let me first tell you what is cup and handle, because once you understand the original logic, you will see why this pattern is so powerful even for long term investing. First, the market rises, it hits a high, and everything looks perfect. This creates the left rim of the cup. Second comes the correction. This fall can be sharp or it can be gradual. The depth is usually 15 to 35% lower than the left rim. The third phase is the bottoming out. The right side begins and the prices slowly starts to climb back up. That is the handle. A small pullback before the actual breakout. This is the part that creates a lot of excitement. The target price is neckline breakout level plus the depth of the cup, meaning if the cup was 100 rupees at the top and then it fell to 70, the depth is 30. And when the breakout happens at 100, the target now becomes 100 plus 30, 130. The entire pattern represents fear, consolidation, strength, breakout, the psychology. It explains every long-term wealth cycle that the market has ever seen. In long-term investing, the cup actually represents falling NAVs, SIP units cost drop, sequence of return, risk reduces. Most investors think this phase is dangerous, but mathematically, this is the safest time to invest because volatility lowers your average cost. For example, a 10% fall in the market, NAV drops, SIP buys more unit. A 20% fall in the market, NAV drops more, SIP buys even more unit. Your risk reduces and your speed of wealth doubles because of cost averaging inside the cup. Handle. This is the most frustrating phase. The handle is slow. It is an irritating recovery phase where NAV moves like a snail, like lazy. You can see here in the Nifty early recovery phase at this time, 2020 and 21. This is the phase where most people lost patience. They paused their SIPs, they redeemed the units, or they shifted funds. They gave up completely, not realizing the handle is the final test before the actual wealth breakout. And a behavioral view, this is where investors quit. But this is where long-term investors are quietly getting rich. And finally, the breakout happens the moment the pattern is completed. So in our observation in year 2020-21, immediately after the breakout, the market zoomed 30% in a very short while. But remember, 30% is only an example and we do not extrapolate that into the future. So use this in creating a mental framework to invest. Now the key point is 30% is from the breakout, but an investor who understands this pattern has bought the units at the bottom, and the units you bought during the consolidation, they start compounding altogether. So you don't get rich at the top, you get rich because you did not stop at the bottom. The cup is a perfect playground for SIP, and here's why. SIP accumulates maximum units in the cup. STP protects capital while giving equity exposure gradually. The handle phase magnifies the compounding on the accumulated units, and the breakout, it multiplies wealth on a low cost unit bought in the cup. That's the real alpha. So your SIP makes the maximum money when you feel it is making minimum progress. Now let us see a historical examples. 2008 to 13 cup and handle lasted for about 5 years approximately. Cup had a 60% crash. Handle lasted for 3 years. Very slow recovery. It tested every investor and most of them quit in frustration. And finally the breakout happened. Nifty tripled in the next cycle. So throughout the long history you can see similar cup and handle patterns. Every wealth story you admire started with a cup. Every regret you have started with panic inside the cup. Now we will see a practical rule. Cup you accumulate, handle you hold, break harvest only if needed. Just follow these 3 rules. Again, this cannot be generalized to all investors as it depends on your risk profile, your goal and your time horizon. 1. Never stop SIP during the cup. 2nd, never lose patience during the handle. This can be very tiring and extended long times, sometimes even longer than the cup formation itself. 3rd, never increase your allocation after the breakout because that is FOMO investing. Cup and handle is not a pattern, it is a behavioral blueprint. Imagine you had invested 10,000 rupees per month through 3 cup phases of 2008, 15 and 2020. Your money would have compounded in each of those breakout phases. The pattern did not make you rich. Your behavior through that pattern made you rich. Now you might be wondering, after the pattern completes, it is very easy to identify that it was a cup and handle. But when you are living through it, how do we know if we are at the bottom, the left side, the right side or the handle? So here is the truth most people don't like hearing. You will never know the exact point inside the cup while it is being formed, but you can always know which phase you are in. Let me simplify this with 3 practical strategies. Signal 1 is deep negative sentiment. The left side of the cup. When the news cycle is full of fear, markets are falling sharply, everyone believes this time it is different. That's usually the left side of the cup. This is where SIP becomes most valuable because the NAVs drop significantly and unit accumulations jump. And the behavior clue is that people stop SIPs, inflows into equity drops, VIX index hits the high, and the news is predicting a recession. This confirms the downward slope of the cup. Signal 2, the markets stop falling, but it stops rising too. That is bottom of the cup, when markets fall for months and then suddenly they stop falling. But also they don't rise in a long stretch. That's the bottom and the consolidation phase. This is usually marked by sideways movements of the market, boring returns, low volumes, no excitement, no panic. Investors get frustrated. This is the area where smart SIP investors build wealth. Signal 3 is the slow, irritating up move. This is the handle phase, when the market begins to see a rise, but the rise is very slow, very choppy, and you keep feeling, why is nothing happening? Why are the returns not coming? That's the handle. This is the phase where investors get impatient. Returns look flat, people switch funds, media says market lacks direction. But mathematically, this is the last phase before the breakout. So if you are bored in the market, you are probably in the handle phase. So you can't predict the exact day of the bottom, but you can recognize the behavior, patterns of each of these phases. Long-term investors do not need to know the exact point of the cup. They just need to stay invested through the cup. So don't waste your energy asking, where are we in the cup? Instead, ask, am I consistent enough to let the cup complete? Because the pattern is not the problem. Our behavior during the pattern is. And if you handle the handle, and the breakout will handle your wealth. Now, this framework works only under certain assumptions. Markets tend to trend upwards over extended periods. These are driven by 2 reasons. One is GDP growth, where economies expand. Second is inflation, where prices rise over time. So use this only as an educational, mental framework. Use your own logic and thinking to take this research forward. If you're a mutual fund investor and you enjoy practical, no-nonsense videos on how to grow, protect, and withdraw your money the smart way, then explore other videos on my channel. I cover everything from SIP strategies, SWP income planning, asset allocation, behavior during market crashes, picking the right funds, avoiding common investing traps, and even unique frameworks you won't find anywhere else. They will genuinely help you become a stronger, calmer, and a more successful investor. If you like the content of this video, please hit the like button, share it with your friends, and subscribe to this channel.